As a real estate agent, my primary goal is to ensure the home buying experience is as smooth and enjoyable as possible. A strong partnership between your agent and lender streamline that process, ensuring that you receive the best possible financing and guidance every step of the way. I'd like to introduce Phil Reece, Senior Mortgage Loan Originator from Homestead Funding. He has been in the mortgage lending industry for 18 years. Welcome.
Thank you. Appreciate it.
So, Phil, what are the long-term financial benefits of buying a home compared to renting?
It's a nuanced question. I would say before interest rates kind of went crazy over the last year or so, it was unequivocally the answer was just buy a house if you can afford it, because it's typically a better financial situation. In some cases, the cost of homes and the interest rates made it so that the payments became pretty expensive to buy a home. And for people who are making financial decisions based on payment, renting made sense for some people. So it isn't for everybody, which is not the answer people often think of a mortgage person's going to say. That said, I think that with the interest rates starting to come down, we're seeing signs of them normalizing. And as that happens, more home inventory will hit the market, there'll be less competition, prices will stabilize, it will help that affordability gap. And from a financial perspective, make it more feasible for people to buy houses again. From a renting perspective, you have to consider that there are lifestyle decisions you have to take into consideration. Do you want something where you have a landlord who handles the maintenance and fixes the boiler when it breaks and deals with all that stuff? Or do you want your own home where you can modify it the way you want? And that's really kind of a core personal decision that has nothing to do with numbers. But all of that said, the financial industry, the tax codes, the way that the American economy is structured is really designed to entice home ownership. There are huge tax advantages to owning a house. And in most cases, owning a house makes more financial sense than renting.
So how much money do you recommend a buyer save to purchase a home?
That's a really hard question, because the price of the house will dictate how much money you need to bring to closing. So how much your down payment is, how much your closing costs are, will be different for a $150,000 home, if that still exists today, or a $500,000 home. I will say for the average purchase price, the number should probably be ideally between $10,000 to $15,000. If you have that much, you're in the game. You're coming up with a decent small down payment. There are a lot of products that have very little down, 3%, sometimes even 0%, depending on qualifications. But the closing costs are expensive. The down payment is the easy part. If you have a loan that requires 3% down and it's $200,000, that's $6,000. You can put together $6,000 in most cases pretty easily. But can you cover the other closing costs, which are often more than the down payment? So if having $10,000 to $15,000 scares you from buying a house, don't worry. There are home grants. There are things called seller concessions where you can roll them into the price of the home. We have strategies, but they're usually not the best option. So if you do have 10, 15 grand, whether it's your own money or a family gift, that puts you in a really good position.
Wonderful, thank you. Okay, so now we have a house that's under contract and we have an appraisal.
Okay.
So how does the appraisal affect the loan process?
So
or the approval of the loan process?
From an approval perspective, an appraiser is somebody that a bank hires that goes out to the property and they give it an opinion of value. It's not a determination. There's no one person who says this is the absolute value, everyone agree with me. But a seller, a buyer, both realtors, all have come to their own opinions of value, and they meet in the middle on a number. And the appraiser's job is to see if that number is appropriate based on the market conditions. Are you overbuying for the home, or did you happen to get a good deal? Either way, they tell you where the value is of the property based on their opinion. If their opinion falls short of the value, maybe you overpaid in kind of a crazy market, multiple offer situation, you might be in a situation where the appraiser says, I'm only going to value the home at $200,000 because that's what the surrounding market says it's worth. But you bought it for $210,000. we don't deny the loan automatically. It just might mean you have to bridge that gap. So if an appraisal value does fall short, you might have to bring more money to closing. And if the appraisal is more than you bought the home for, then you got a good deal and just don't tell the seller.
Perfect.
All right, question number 4. How does flood insurance affect the loan?
So flood insurance is expensive. Homeowners insurance in the Northeast is pretty inexpensive. I see homeowners insurance policies for $800, $900, $1,000 for decent size and priced houses. Can't get that in like Florida, where you have a lot of natural disasters and such. But flood insurance can be catastrophic insurance. And there are limited options. You have FEMA, which is through the federal government, and there are private insurers, but there are not a lot of them. So you could have a flood insurance policy that's $3,600 a year, but that means that now your monthly payment is $300 more per month because you have this annual insurance policy that you have to keep paying for each year. So if you're evaluating 2 different homes, it's going to cost more on the home with the flood insurance policy. So I feel bad for sellers with flood insurance because they might have to equalize the price of their home to offset that cost for future buyers.
Excellent. Question number 5. Do you think we will ever see rates as low as 3% again?
No. Not from now until I retire, at least. The 3% rates were what I have been calling for a couple of years artificial rates. They really shouldn't have existed. In any normal market, they would never have existed. The pandemic was crazy, and the Fed didn't know how to respond. Nobody knew how to respond to those changes that we're dealing with at that time. And they needed to kind of revitalize the economy. So they put a ton of money that we didn't really have, but it's a whole different conversation, into the bond market. And that was designed to kind of speed up the economy. And what that did is, by infusing a lot of money into that portion of the economy, it lowered interest rates for everything. Credit cards, home equity loans, car loans. That's why people bought cars like crazy, probably because they were sitting in their houses too. But home loans hit record lows, and they were artificially infused. You won't ever see that again unless we have some other weird catastrophic nightmare, hopefully not. I think that the average rate probably should be about 5. And there will be times that they'll dip below that, and right now we're above that. But I don't think we'll see 3.
Excellent. Final question. If you had one bit of advice for a home buyer, what would that be?
Take your credit seriously, especially for younger people. And if you are not sure where your credit stands, find a lender like Homestead Funding that can do a soft pull of your credit report. And I will combine that answer with getting pre-qualified as early as humanly possible for a buyer. There's no downside. If somebody calls me and says, hey Phil, I'm kind of thinking about buying a house, but I might not do something today, it may be a year from now, they're the ideal client for me. Because if I can identify a problem, whether it's you need to save more money, or you need to wait for that pay raise to qualify for more house, or you need to work on credit, those things can take time. And if I can give you tips today that you can work on over the next 12 months and put you in a stronger position a year from now, you will be a better buyer. You'll probably qualify for a better rate, a better product, buy more house. So take your credit seriously and do that qualification review early, as long as it's a soft pull and it doesn't adversely affect your scores like we do.
Excellent.
Wonderful. Well, thank you for being here today.
You're welcome.
I appreciate you.
Likewise.
And if you ever need any help with real estate or mortgage, home lending, give us a call. Our information will be at the end of the reel. So thank you again.